Stock market is currently down 4% in the last week, and with investor sentiment solidly in the extreme fear category, many people are wondering whether this is a good opportunity to buy or to wait and hold cash. In this video I'll be discussing two stocks that I'm actively buying in my £51,000 stocks and shares ISA held on Trading 212 before carrying out a valuation on both companies to see if they're trading at good buying prices. If you get something out of this video, then don't forget to leave a like and consider subscribing to the channel to help it grow. So stocks are down considerably, with S&P 500 down around 4%. A lot of people are getting worried about their positions. Some stocks are underperforming more than others, and I think that has a lot of people concerned. And it's very true in my portfolio at least. We was at a high of around £55,000. We're now down by over around about £3,000 to £4,000, so it's a considerable amount. And that hasn't impacted us on any particular positions. We're all in the green. But one position like Amazon, for example, is down 12% in the past month, and 6% of that has been down in the past week. So that's actually underperformed the market yet again, and same with a lot of other positions. So I want to talk about two positions that I've been actively buying into on this dip that we're seeing in the market, because I see there's good opportunities there. And I want to see if you guys can see it as well, if I evidence it correctly. Now, the main reason that we're not seeing those buys in this account is because I cannot contribute to this account. This account has had its £20,000 allowance. I'm not allowed to contribute anymore, and we've got £0 remaining that I can contribute for the year. So I have to wait until April in 2025 to add to this account, and my free cash is just burning a hole in my pocket with the opportunities I'm seeing in the market at the moment. And this leads me to do stuff like this, which is put my money into the invest account, which is the taxable account on Trading 212. Now, there's a reason for this. It's because we get a considerable interest rate, around 4.9%, on free cash that we have in this portfolio or just held in the account. And that basically means that I can actually just put money in there like I would a savings account. It's in qualifying money market funds, so it could be seen and argued that it's not as safe or whatever, but to me, it's still a very safe form of investment that I'm more than happy to have my spare cash in. I still have my emergency fund held in my savings account. And this money is something that I add every month, and I've been adding actively to this invest account. We can see we've got £398 here. That's receiving that 4.9% interest. And we can see that we've got around about over £5,000 here in positions and in free cash. And I've been adding to two positions in this account because I've been unable to buy them in my other account. So we're going to be going through those shortly. The first of which is, of course, Google. Now, I've only added a bit towards this position. I've got quite a lot in my stocks and shares ISA, around about £5,000 worth, and I've been buying more. And the reason for that is I was actively buying Google when it was around $170, and it's relatively come back down to that sort of level. And I think that's quite ironic because people were talking about the quantum sort of chip manufacturing that they were doing, and their story with AI and how their cloud was growing and stuff like that in January. And now, all of a sudden, the stock is down around about 13% for the month, and everyone hates Google again. It's a dying business, search is going to drop off and stuff like that. So in the past week, they're down about 8%, and I just think that this sort of thing can't continue. The sentiment will switch around again because Google's a very high quality holding. And I've added around 8 shares, an overall value of just over £1,000 now, with a cost per share sitting around about $169. And to explain my reasoning for why I've been buying into this company, it's because it's continuing to perform. The fundamentals are getting better whilst the share price is coming down considerably. And this is true through their last quarter earnings. So as we can see here, Alphabet revenues for Q4 year over year grew 12% right at the top there to 96.5 billion. And their Google services, which includes YouTube ads and search, have grown by 10%, with search growing on its own by 10% as well. So to me, everyone talks about search is dying off for Google, and it just doesn't seem to be. The fundamentals aren't matching that narrative. The narrative is that Google search is dying off because of the likes of Grok and ChatGPT are slowly pushing it out. And I think that is not really true or reflected in the fundamentals here. Additionally, probably one of the best growth drivers for Google and one of the good reasons to invest in this particular holding is Google Cloud. They're increased to around about 30%, $12 billion in revenue, and that was mainly due through to their cloud platform. They talk about AI infrastructure and generative AI solutions as well. And I think that's still growing and means that this one is growing the fastest out of the three big cloud providers. You've got the likes of Microsoft, which has come down a little bit in growth. Amazon, which is staying flat at about 19% growth. And 30% growth is still a very impressive growth rate for Google Cloud, even though it's come down for around about 35%. So you can look at it negatively and say it's deaccelerating, but to me, anything above that 30% range is still very good and still incredibly impressive for me wanting to own this business. But all of those things really add up to, as well as their growing profitability as well, their EPS increased by 31%. So I'm seeing this company grow every fundamental metric between 10 to 30%. This is not a dying business. This is a business that is growing very well. You can see this on their cash from operations or operating cash flow, which is not affected massively by the high capital expenditure that we're seeing because the free cash flows, I think, are skewed right now. Google's free cash flow is largely flat for the last couple of years because of the massive spending surrounding AI. And I think it's unfair to judge Google based off that continued free cash flow expenditure because it could suddenly end. In a couple of years' time, we could see their free cash flow skyrocket because their margins expand and they're no longer spending as much money on the AI infrastructure. But they are seeing a return on invested capital for that, and they believe that's a good investment. We'll have to see on that part. But in this particular case, we're looking at cash from operations, and here they are consistently increasing. We're back in 2017, they were sitting at 36.2 billion operating cash flows, and now they're sitting at 125 billion. So in the space of, around about 7 years, 8 years, we've almost, quadrupled? Yeah, so 4 times their cash from operations, which is just very impressive for this business. Now, it has slowed down a little bit, but in this past quarter, we've seen a massive jump again. So, to me, 11% operating cash flows growth CAGR over the past 3 years is still very good, it's still very positive, and looks like it's really accelerated in the past quarter. Now, the reason I believe this matters is because I like to look at historical metrics to gauge how a company's been valued in the past and how it's being valued now to sort of gain an insight into how it might be valued into the future. And that will inform our decision making on the valuation shortly. In this particular case, we've got their price from operating cash flow and price to earnings here over the past 10 years. And looking back historically, they now sit at a price to operating cash flow of 16 times and a price to earnings of 20 times. And forward looking, they're probably sitting closer to about around 16 to 17 times price to earnings forward looking. So that's very good metrics for a company that's growing quite considerably, the likes of Google. And it's also one that's got a massive moat, in my opinion. So some people may think search is dead, I just don't, and I don't think the fundamentals back that up either. In this particular case, if we look at the averages or the medians down below, whichever one you prefer, in terms of their price to earnings, they've got a 27 times price to earnings average over the past 10 years, and they're currently sitting at 20. So that shows a considerable amount of undervaluation there by a massive amount, and would signal undervaluation on just looking at that metric alone. Then we've got their price to operating cash flows, which I think are a bit more intrinsically focused on their valuation. I prefer operating cash flow for looking at other businesses. And I don't think it's as skewed as much as free cash flow is for Google, because I do not believe that is a fair reflection on this company. In this particular case, they've got a 16 times price to operating cash flow, and the average over the past, or the median, is sat at 17 times. So they're sitting just below that. So that would signal fair to undervaluation there. And both of these metrics look quite good for the likes of Google. Now we can use those historical metrics and their previous historical valuations to help predict what we're going to sort of value this company at in the future and what sort of return we could be looking to get if we bought Google around the current share price of $169 to $170. In this particular case, we're going to use operating cash flow because I believe this is the middle metric for Google. It's not the very harsh outlook that free cash flow would probably show on this company, being flat over the past 3 years. It doesn't look good. But it doesn't show the massive sort of outperformance that we'd be likely to see it if we looked at price to earnings, because price to earnings look very good for this business. So I've chose operating cash flow in the middle. We're doing a 5-year analysis, and I'm going to give a metric growth rate that is well below their 5-year average, because we want to be conservative with our estimates. Over the past 3 years particularly, we saw that Google's operating cash flows are now sitting at 11% CAGR. So we want to allow a bit for that and continue if that deacceleration continues a little bit to 10%. I don't think it will. I think it will sit around about 11%, maybe increase a little bit, but we'll have to wait and see on that. And we allow for them buying back around about 2% of their share count, which is their norm over the past 5 years. Dividend growth rate we've set at 12%. And we've set a price ratio for operating cash flow that sits around 17 times. It obviously currently sits at 16 times, and the average over the past 5 years is 17. So we're going to keep 17. In that particular case, it now seems like we get a fair value for this business, around about $196 per share, and around a CAGR of 13% over the next 5 years, which is a market-beating return that we would be looking at. So it'd still give us a margin of safety. And I think this is sort of fair towards Google. I don't think there's any nasty surprises here. I think that we could be more conservative and we could be more aggressive with our estimates. But I really like Google's price sitting below this $170 because it gives me a good margin of safety. And that is why I've been buying into this stock recently. And there's another position that I've been actively buying into, and that is Brookfield Corporation. I didn't buy as much as I did with the likes of Google, but I bought 11 shares of Brookfield Corporation around a week or so ago, around about £500 worth or just below that now. And it's down by about 2% currently. But I don't really mind. I do think that this one is still undervalued, and there's a couple of very good reasons for that. One of the main reasons being that they expect their free cash flow or distributable earnings to grow around about 20%, if not more, in the next 5 years, which is massive when we consider this is one of the best management teams in the world saying this. And this is what they expect. So they're anticipating their insurance wealth solutions side of the business to grow massively, over doubling in the next 5 years. Interestingly enough, it's already doubled between 2024 and 2025 in terms of amount of money it's bringing in, followed by a solid increase in their asset management business, BAM. So the growth is coming mostly from these two businesses. And this isn't all what they're expecting, because they're expecting carried interest and capital allocation to also increase that distributable earnings after realizations by 25% year over year, which is massive. And this company actually met all of its guidance in the last 5 years that they actually anticipated. So this is something to take into account when seeing if this guidance is realistic. So now we have their guidance, which guides for around 17 to 25% growth in distributable earnings. Now we've got to look at a price that is appropriate to pay for those earnings. So for a price to distributable earnings or free cash flow. In this particular case, they're currently trading at a market cap of 93.6 billion, and they're producing 4.6 billion in distributable earnings before realizations in the trailing 12 month. So that's what this little sum is here. We've divided that market cap by the distributable earnings that they've made in the past 12 months to give us 20 times. So 20 times their current price to distributable earnings over the trailing 12 months, which is still a very low metric for how quickly they're growing, if you ask me. And then we've got to apply that to their growth rate. So if we say that their free cash flow or distributable earnings is got a 5-year time horizon, is going to grow by 17%, the lowest end of their guidance before distributable earnings. And then we say they're going to appropriately or opportunistically buy back shares at minus 1%. We give it a dividend growth rate around 10%, which is what they increased it by in the last quarter. And then we give a price ratio that sits at the same value that it currently is, 20 times. 20 times price to free cash flow if nothing changes, or distributable earnings, sorry, I should say. So 20 times if nothing changes. And if that particular case all comes true, then we get a fair value for this particular stock at $81 per share. And that's a 43% upside, or a CAGR over the next 5 years of around about 18%, which is still very good. And it's massively conservative as well. They've guided for a lot higher than that with their after realizations of 25% CAGR. And if we looked at it more on a basis of being less conservative and allowing for that after realizations number to come into it at 20% growth rate for the next 5 years in their distributable earnings, then we get a 21% CAGR and a fair value of $92 per share. So whatever way you want to look at it, I prefer to be on the conservative side. I do believe that this guidance that they've given is achievable, and that in general this is still looking like a very good price to get Brookfield for. But what have you guys been buying? Do you like my buys, or do you not like them? I don't know. Let me know down below. As always, thanks for watching. I appreciate it, and I'll catch you in the next one.